What if you could stop needing to work for money years? Maybe even decades earlier than most people plan to. Not because you got lucky, not because you were born rich, because you ran a simple plan on purpose. How early depends on your income, your savings rate, your lifestyle, and a bit of luck with the markets. So I won't promise you a specific age, but the direction is real, and an ordinary person can run it. I'll be honest up front, the plan is boring. No hot tip, no get rich quick. No 10 stocks that'll explode this year. The boring version is the one that actually works. Here's the whole map. Make your savings compound. Stop the leaks. Because earning more is pointless if your pockets have holes. Raise your income, sharpen your judgment, and avoid a short list of mistakes that can wipe it all out. One warning before we start. The comments under a video like this fill up with people promising to grow your money fast. They are scammers, every single one. Anyone guaranteeing returns far above the long-run market average is lying. Never send money to a stranger online. The real plan is slow, and slow is the point. Start with the bad news because it makes the good news land harder. Cash sitting still doesn't stay still. Inflation quietly eats it. Prices climb most years. Rent, food, everything, while the supply of money keeps growing, which dilutes what your savings can buy. Picture it. You bury a stack of cash in the backyard. 20-some years later, you dig it up. The number on the bills is identical, but it buys far less than it used to. You didn't lose money, you lost purchasing power, which is the only thing that actually matters. Holding cash is technically an investment. It is just a poor one over long stretches. So we need something that works against inflation for us. Ideally, something that earns over time and keeps renewing itself. That is not a fantasy. Let me show you. Over the last 100+ years, people have studied every major place to park money, cash, gold, bonds, and stocks over long periods. A broad basket of stocks, with the income reinvested, has tended to come out ahead. How much? For US large-cap stocks. Long-run nominal returns have often been discussed in the high single digits to roughly 10% a year before inflation, depending heavily on the exact period you measure. I want to be careful. That is a historical average, not a promise, not a straight line, and not guaranteed to repeat. Some years are great, some are brutal, but watch what even a modest return does over time, because this is the whole reason early retirement is possible. Say someone earns around that long-run average on a chunk of money. After 30 years, it has grown several times over. Now add just 10 more years, and it doesn't grow a little more, it leaps. Because year 31 builds on 3 decades of growth, not on the original amount. The longer you stay invested, the more dramatic the back end gets. That is the quiet secret behind the famous long-term investors. It is less that they're geniuses and more that they earned a decent return and then stayed in the game for a very long time. Time is the ingredient nobody can fake, and small differences in the rate matter enormously over decades, which is exactly why we'll obsess over keeping fees low. So if stocks tend to win over long stretches, why does almost everyone who buys individual stocks struggle? You've heard the grim version. Most stock pickers don't beat the market for long. That is closer to the truth than people want to admit. Here is why. Buying one stock means buying a slice of one company. To do it well, you'd need to answer correctly and about the future. Is it cheap or expensive? How much does it really earn? Is the business durable? Are the numbers honest? Is management any good? Will it still matter in 5 years? Be honest. Can you nail all of those at once without overpaying? Almost nobody can. There is a trap too. When a beginner buys one stock and it wins, that is often the worst outcome. The market just rewarded a gamble, which tempts a bigger bet until one bad one undoes everything, and it is draining. The price lurches daily. Every lurch tugs your emotions, and you end up babysitting a moody machine instead of building your life. For most people, stock picking isn't worth it. The better tool, an index fund. It is a basket that automatically holds a whole list of companies, chosen by fixed rules set in advance. A broad market index fund holds hundreds or thousands of companies according to clear rules. As long as those companies as a group keep earning, the basket tends to drift upward. Here is the elegant part: the rules do the maintenance. A company that fades gets dropped and replaced by the next one rising up. Companies are mortal. But a broad rules-based index is built to keep replacing them. So the basket keeps adapting without you having to pick each company yourself. Two more advantages: fees, because the rules are automatic, nobody expensive is steering. So a broad index fund can cost a tiny fraction of an actively managed one. And over decades, that gap alone is worth a fortune. And track record, year after year, most actively managed funds fail to beat their index after fees. One famous example, a decade-long, $1 million bet where one investor backed a simple low-cost index fund against a set of hand-picked professionally managed funds. 10 years on, the simple index won comfortably. Most of the pros couldn't keep up after costs. It is one story, not universal proof, but it points the same direction as the broader data. A beginner quietly buying the index can outperform most experts. Not because the beginner is clever, because the system is. Here is the move built for someone with a paycheck. Don't try to time it. Automate it. Put in a fixed amount on a fixed schedule again and again. That is dollar cost averaging. And for money you won't need for many years. Think in decades, not months. It is a practical fit with a broad, low-cost index. Why does it help? Take the scariest case. You start buying a fixed amount each month right before a crash, and the market falls for over a year. Are you down for a while? Yes. Anyone who starts before a drop can be underwater for a stretch, but here is the quiet mechanic while prices fall. That same fixed amount buys more shares each month, pulling your average cost down. In some of those paths, you climb back into the green faster than you'd expect. Not because you predicted anything, but because your costs fell while you kept buying. You were forced automatically to do the hardest thing in investing, keep buying when everyone else is panicking. That is the whole point. It is simple, it is mindless, and it makes you behave well by default. Over time, it tends to draw a smile-shaped curve. You plant through the dip and harvest later. Now, valuation, you'll hear people ask, but is the market cheap or expensive right now? Treat that as a weather report, not a steering wheel. If the market is historically expensive, it is reasonable to expect lower future returns and more emotional turbulence. If it is cheaper than usual, expected returns may be better. But the core plan doesn't depend on calling the top or the bottom. It depends on steady contributions, low fees, diversification, and time. You don't need a valuation system to begin. What about a lump sum you won't need for years? There are two honest choices. Investing it sooner usually means more time in the market, which has historically helped because markets trend up over long periods. Spreading it out can reduce regret and the sting of bad timing if you'd happen to buy right before a drop. The right answer depends on your risk tolerance and, honestly, on how badly a sudden 20% drop would mess with your behavior. Either way, only money you won't need for years, no borrowing, no leverage, and fees as low as you can get. Because here's the thing you need to hear before it happens. No asset only goes up in a straight line. Over the long run, these broad baskets have trended upward, but drops of around 20% happen often enough that your plan has to be built to survive them, and bigger ones happen in real crises. Long-term up does not mean smooth. So how do you survive a drop? 3 things. Read enough that you know why you're holding. Only invest money you won't need soon, so you're never forced to sell at the bottom, and never go all. Keep a reserve so a crash feels survivable. A seasoned saver still feels uneasy when the market falls. That is human. But also sees the other side of it. Future shares just got cheaper. If you're new and your very first month is a loss, that is normal. If it rattles you, the understanding hasn't fully landed yet. Pause, reread. Get the why solid before you continue. And the payoff as the pile grows into a meaningful nest egg, you can eventually live on a carefully chosen slice of it each year, while staying flexible when markets are rough. That is the point where your money starts working harder than you do. That is financial freedom, and when you reach it, it is okay to actually enjoy it. Compounding is only half the battle. The gap between what you earn and what you spend is the fuel, and consumerism is designed to drain it. Understand one law past your basic needs. More stuff gives you less and less extra happiness, while every object quietly taxes your attention. Stuff breaks, needs storing, needs maintaining, eventually needs selling. And the hidden price of all of it is your time. The things that bring lasting joy are usually cheap: real sleep, a walk, a good film, time with people you like. but spend generously on a few things, because being cheap here is foolish. Things that touch your body for hours, a decent mattress, a good chair, because sleep and health compound too. Tools that help you earn and get reused. Those are investments, not costs. Yourself, because you're the biggest asset you own. And books, because they're the cheapest upgrade to your judgment you can buy. The goal isn't to live like a monk. It is to stop bleeding the exact money that is supposed to be buying your freedom. When you're young and the pile is still small, the fastest growing number in your life isn't your investment return. It is your income. So let's grow it. Most people stall because they only ever learn one sliver of a process, one arm of the machine. One arm can only ever be an employee, but learn enough pieces to run the whole smallest version of the machine. And you stop depending on a single employer. You can serve the market directly. Many jobs are designed around narrow responsibilities, which makes the company efficient but keeps your skill set narrow. So treat the job as paid training, collect the missing skills while you're getting a paycheck, until you could run the whole loop yourself. A concrete move. Find someone a few steps ahead whose work you'd actually want. Take them to lunch and reverse engineer the specific skills behind it. Now you know what to practice. And to actually get promoted, understand how work gets graded. Routine work, anyone can do it, and finishing it just meets expectations. Creative, harder work. That is what earns real credit. The catch. Bosses hand the good work to whoever already looks safe and pile busy work on everyone else, which keeps them stuck. To break out, exceed expectations on the small stuff, until you earn the big stuff. Turn a 3-day task into a same morning delivery. Hear your boss complain about something offhand, and come back with a solution and a number attached. This change saves us X. Anything that lifts revenue, cuts cost, or delights a customer without being asked reads as exceptional. Because you went past the brief, and modern AI tools lower the starting barrier, but judgment still decides who uses them well. The person who moves fastest and thinks clearly finds the improvements first. There is a quieter kind of compounding, your judgment. People who build wealth from nothing tend to share one habit. They collect mental models over time, so they make slightly better decisions more often, and good decisions compound just like money does. If you're thinking, I'm not a reader, I can't do this, that is a fixed mindset, not a fact. The brain is genuinely trainable. Start with easy books, even cheesy ones, just to build the habit of finishing them. Then read across different fields, because the real edge isn't one fact. It is connecting ideas from places other people never bother to look. And the payoff is concrete. Reading about incentives helps you negotiate better. Reading about accounting helps you spot a weak business. Reading about psychology helps you avoid panic when the market drops. The mechanism is simple and unglamorous. The person who assumes a skill is learnable is the one who keeps showing up long enough to actually learn it. Reading is one of the highest return per hour moves. Available because every book is someone handing you years of their experience for the price of an afternoon. A short list of hard rules. Don't pour hours into studying investing while your pile is tiny. Early on, raising your income pays far more. Don't scale up a team or partnership before you're ready, and the people genuinely lift you. Don't confuse consumption with investment. One takes money out of your pocket, the other puts cash flow in. Don't gamble with your health. Sleep and energy are the zero in front of every other number. Don't bet everything on one thing. Keep a margin of safety in your career, your money, and your life. And don't ever quit the two compounders, money and judgment. They only work if you stay on them. So here's the whole plan in one breath. Let your money compound in something diversified and cheap. Stop the leaks, raise your income. Sharpen your judgment, and never break the few rules that can ruin you. None of it is clever. All of it is boring. And that is exactly why it works, because boring is repeatable, and repeatable is what survives the decades compounding needs. You don't need rich parents or a hot tip. You need a plan you can run on autopilot and the patience to let time do the heavy lifting. The slow road is the only one that actually arrives. If this gave you a clearer map, start today. Small, boring on purpose. Stick with it, and stick with me.